Chinese government has accused the U.S. of starting, quote, the largest trade war in history after U.S. tariffs on $34 billion worth of Chinese imports officially went into effect today. Escalating tensions between the two countries are leaving many investors wondering whether the U.S. economy can withstand a trade war with China. Here to give their takes is Jeffrey Cleveland from Payden and Regal, and Maddie Doppler is a visiting fellow at the Independent Women's Forum. Ladies and gentlemen, good to have you here. Maddie, did you see the numbers that came out today in terms of employment numbers? I mean, if ever there was a time that you wanted to do this, wouldn't it be now, considering how well things are going?
Yeah, Michelle, I would argue there is never a time that you want to start a trade war, especially now. Now, of course, looking at the job numbers today, you see a lot of strength reflected there for the other pillars of the Donald Trump administration's agenda. The tax cuts and deregulation, of course, are powering economic growth forward. However, I do think you see some weaknesses there as well, and I'm talking about the wage growth, or the lack thereof, that we've seen this month and the last. You know, about this time, we'd start to see those numbers shake loose, and they remain stubborn. I believe that is an indication that moving forward, we're going to continue to see hesitancy from businesses that otherwise wouldn't be there. You'll recall from last year, one of the major driving forces of growth from the Tax Cut and Jobs Act was the way that would realign business incentives so that businesses would invest here at home. We're not seeing that amount of investment back in workers, so we're not seeing productivity gains or the higher wages that would result.
Got it.
Jeffrey, your take in terms of the strength of the economy being here to stay during this trade dispute?
To quote the Fed, the economy is very strong, and I think it can withstand a little bit of light turbulence. We're talking about $34 billion in goods in a $20 trillion economy. So the focus and emphasis by investors on the trade war, I think, is entirely overdone. Growth continues. We're now in the 9th year of this expansion. We're still adding jobs at a clip of 200,000 per month. And we don't see any discernible sign of any sort of uncertainty on things that we like. If we're looking for the trade war to show up in terms of the economic data, we should see it first in the ISM surveys, the manufacturing survey. We're not seeing that, actually. We're seeing the best.
How about in the Fed minutes yesterday? We saw it right directly in the Fed minutes yesterday.
I think almost for investors and for policymakers, it's something you have to talk about. It has to be discussed around the table. So, of course, they're going to reference uncertainty. But we're not seeing it in the data. The ISM Manufacturing New Orders Index was the best that we've seen in about 20 years. We haven't seen such a good run in 20 years for manufacturers. So we're not seeing it pull back. And to the earlier comment about not seeing the tax plan feed through into the economy for business investment, we're actually seeing business investment creep up. So we actually think that will boost the economy here in 2018. And we'll see 3% or just about 3% GDP growth for the year, which is outstanding.
Okay.
So
I totally agree
that
that's outstanding, and I should be clear that I remain optimistic about this economy, but I'm realistic about the challenges ahead. And I do believe that especially those Fed minutes released yesterday indicate exactly what we're up against here. The uncertainty that is created by these trade wars and these tariff threats undermine all of the other great fundamentals that we're looking at right now. I mean, the tax cut is really one of the biggest things you could do to remove the barriers to growth that the economy has struggled against for so long. And all of that stands to be eroded by uncertainty injected unnecessarily by these threats of trade wars with other nations.
Jeffrey, do you think we're late cycle, i.e. that in a year or two's time that a lot of things, whether it's trade related or not, could unwind?
Well, we're nine years into the cycle, so it's a long cycle. I think what I would say is that these economic cycles of late, the last 2 or 3 cycles, have been longer. So what we formerly might have expected a 60-month cycle or a 70-month cycle, we should expect it to lengthen. And so maybe, if this is a baseball analogy, this is the 7th or 8th inning, and this game is probably going to go to extra innings. I think we'll make it into 2020 or even 2021 without a recession, because we just don't see the signs that you would need to see for a recession are just not on the horizon right now. All the tariff talk notwithstanding.
Maddie, you don't like the methodology that we're seeing, but do you agree with any of the issues that have been highlighted by members of the administration when it comes to trade, when it comes to uneven playing fields in terms of tariffs
I certainly
or
do.
the Chinese?
I 100% agree with the administration, with the president, that the United States deserves to be the strongest economy on earth. And we certainly can be that way. We have seen trade policy that doesn't undermine the strengths that we already have. And I would argue that there's one more point that hasn't been raised that will be fleshed out as we move closer to November. And that's the political instability that will be fostered if we see political differences in the House or in the Senate come in November. If trade undermines the strength in the economy, we know what that bodes for current leadership in Congress, and having a divided government next year will certainly increase instability and will not be a good reflection for the strength we see in the economy right now. That's another worry.
But what do you do about China? My question was, what do you do about China? Anything?
Well, I certainly don't think that having unilateral trade threats and tariffs is the way to get around the China problems. I think having a very acute approach to the offenders in China is the way to deal with intellectual property theft and the other issues that we've seen emerging with that country. Making our farmers and consumers pay for the mistakes and malfeasance of bad actors in a different country is not the way to go about that problem.
Jeffrey, stepping away from the trade dispute, clearly data around the rest of the world has started to slow, and that's impacted monetary policy in places like Japan and Europe. Is that a big headache for the Fed because of what the impact it's having on the yield curve here?
I think the question some clients are asking is, are we seeing a repeat of the 2015-2016 period where we saw global economic data slow, China was weaker, the dollar was stronger, and then that forced the Fed to pause? And I don't think so. Actually, as we've said, the U.S. data is strong. This week, we saw the global PMI data perked up a bit, actually. So we saw that rise. Much different in terms of the global PMIs now compared to 2016. We're talking about 54 on global PMI data. We were closer to 50 on the manufacturing PMI in 2015. That was much more worrisome than the present. So I'm actually optimistic. I think the global data is starting to turn, and we'll see that reflected in the second half of the year. And that will be a boost to asset markets generally.
Okay, we will leave it there, guys. Jeffrey and Maddie, thank you both very much.
Thank you.
Thank you.